Hi everyone, so let's talk about how you can trade the 1-1-2 put strategy on gold futures specifically. It is different for every single product. So on gold, there's some specifics, gold futures, and it can be really profitable on gold. So let's talk about the how, the position management, and exactly when to do it, because this is, I guess, the most important thing. And we'll go over an example, and it should make a lot of sense pretty quickly. So how would we do it? Well, the short put will be at about delta 5, and the long put spread will be at about delta 25 to delta 35. I'll show you exactly how you know when to put it or where to put it. And the days to expiration should be always around 45 days to expiration. This way it can be in and out of the position really quickly, and this way you minimize a lot of your risk, and you still have some protection if the price does move down because you have the long put spread. For the position management, the take profit is at 50% of credit. And I know it's a bit different than the other 1-1-2s you probably heard about on the internet, but I've done many different strategies. I have almost 10 years of experience, and this is the most efficient way to kind of trade the 1-1-2 on gold specifically. Now, the risk management, there are a few things. You can sell the future contract if price is reaching the short put strike, and this way you will completely eliminate risk. But its price is very unlikely to get there in the first place, and overall you'll stay in a position probably, I don't know, less than a week overall, right? Or you can also set a stop loss at 200%. For myself, I would probably have like a mental stop loss at maybe 100 or 150%, and at that point I will have to make a decision. Do I stay in the position? Do I hedge? Do I do this and that? So it depends on the scenario. Overall, if you really want to go on the safe side, you can be out of the position if it's down about 200%, and you won't have to worry about a thing, and it will happen once in a blue moon, if anything at all, really. And obviously, as a position is profiting, you can maybe, if the position is up 25%, maybe you can lower your stop loss to like down 50% or down 25%, which is also something that I do with all my strategies, because it makes a lot of sense, and it will save you in the future. It will make you'll end up keeping way more money when you take a loss. So this is pretty cool. For the position sizing, I'll be collecting or should collect about 1% of your account in credit. I know it's not a lot, but you'll make about 0.5% on your account within a few days. It's pretty good, and I know this is not those massive returns, but it's stable, it's safe, and this is ultimately what I'm doing. I'm managing quite a bit of money, or actually I guess some would say it's not that much money, but I would collect about 1% of credit. Some people have different preferences, they can collect more, but this is what I would do. And then when would I open the 1-1-2 on gold futures? Well, I will do it if gold futures are in a clear side trend or an uptrend. For me, if it's a side trend, I will probably end up just selling a strangle. But if volatility is low, definitely do the 1-1-2. But if it's a clear uptrend, you can also do the 1-1-2. And anything else in between, if it's in a downtrend, then obviously there's no reason to enter the put 1-1-2. So let's see what it would look like here on Interactive. So we will sell, and I'm looking at 36 days to expiration. This is the closest expiration to 45. So we'll go to delta 5, which will be right over here, delta 5.2, let's call it. And we can collect about $4 in credit. So it's 4 times 100, so $400 per contract. Obviously, we will sell 2 of these. So we will have 2 of the puts. And then we know that the spread that we buy should be worth around $4. So if we go to delta 35, so it's right over here. So we will have to buy it. And then we can see the full price that we will get is probably about 41. So we can probably sell this one over here. So we have a nice spread over here that really helps us if the price goes down. It's a really high delta 35. So you can feel the protection right there pretty quickly. Now the credit that you can collect is probably going to be closer to $4.50, give or take. So let's redo this position on Optionstrat and see what it looks like. but generally speaking, we are looking at 35.55. We're looking at a short put somewhere over here. Then our long spread is going to be, where is it? At 33.75. So 33.75. So this is where our protection is, which is really close to the price, as you can see, really good. And this is our short put. And as you can see, the price is moving sideways currently in a nice channel on gold. And it already went up as I'm making this recording about 1.5%, but it's still moving sideways. And if the price is moving sideways or it's in a clear uptrend, you definitely can enter the position. And this is kind of like the more important thing. If you cannot tell clearly that the price is moving sideways or it's uptrending, then you're not entering a position. If it's really clear to your eye, then really easy, we get into it. So with that, let's look at the option strat. So we need to sell the 31.55 right here. And then we are buying, let's see, we are buying the 33.75. So 33.75, which is right here. And then we are selling the 33.65. 33.65. So this is basically the payoff diagram. So we are going to receive about $470 in credit. Now, what is our theta? If we take profits at half, let's call it, $240 in profit is what we can get. So if you look at a theta currently, it's $53. So you are aiming for $240 in profit. Your theta is 53, which means it should take you 4.5-5 days max to get to your profit target, which is pretty remarkable. And this is obviously what the payoff diagram looks like. You can make more money if the price drops, but the whole point of the long put spread is just to have some protection if price drops quickly. You never ever want to let the position go all the way down here. And this way, obviously, we have a 95% chance to profit to keep the entire credit. But because we're taking profits at half of this, the probability goes up to 97-98% pretty much. So it's pretty remarkable. But again, you gotta know when to use whatever tool you have at your disposal. So for us, it's the 112 is done only if the price is going up clearly or it's moving sideways clearly and it's on gold. So this video is specific to gold. Please remember that. It's not the same thing with all the products, and I'm gonna make videos for each and single product. Some products have seasonality patterns, so it's gonna be different. So it's not a one type fits all, unfortunately. But at the same time, this is the beauty in trading, that each product has its personality. And for gold, this is exactly how I would trade the 112 with a really high probability of profit, and make some good returns. So thank you so much for watching. I hope this video was useful. There are more coming videos that are really interesting and really specific to products, which I think will be really beneficial. So thank you again, and I will catch you in the next one.